Welcome to Investing 101, Lesson 3, Stocks. Stocks, also known as equities, allow investors to profit from a company's growth and income. Every corporation will have a set number of shares, and each of those shares will have a particular price attached to it. Apple, for example, has 6.5 billion shares, each valued at about $153 a share. The price of a company's shares is determined by what investors think of that company's future. You can think of the stock market as a sort of never-ending auction. If investors are excited or bullish about a company's future, then they will bid higher and higher for that company's stock, making the share price go up. However, if investors become wary or bearish about a company's future, then they will bid lower and lower for that company's stock, making the price decline.
Oh, bother. Double bother.
Investors base these decisions both on how much the company is making right now, as well as how much money they think the company will make in the future. As an investor, there are two ways that you can make money through stocks. One is through share appreciation, and the other is through dividends. Now, share appreciation simply means that if you sell a stock for more than you bought it for, then you made money on it. That share appreciated in value over time. For example, let's say you bought a share of Apple when it was $150 a share, and then you sold it for $160 a month later. You gained $10 in profit. If, however, you sold that share for $140, then you would have incurred a $10 capital loss. Note that if you don't sell your shares, then it doesn't matter what the price of the stock is. It only matters what the price is when you bought it and when you sold it. For example, let's say that Apple went up to $200 a share and then down to $100 before you eventually sold it at $160. It didn't matter what the price was during all that time. The fact that it was at $200 or $100 doesn't matter, except for the emotional roller coaster it might have sent you on. The other way to make money from stocks is through dividends, which are always positive. Not every company in America pays dividends, but most do, and they usually pay them quarterly, about once every 3 months. When a company declares a dividend, they declare a certain amount of money per share that they will pay to all people who own shares on a certain date. For example, in 2018, on November 1st, Apple declared that they were going to pay 73 cents a share to all of Apple's shareholders who owned Apple on November 12th, with the actual funds being delivered on the 15th. So let's say you owned 10 shares of Apple on November 12th. $7.30 would have been deposited into your brokerage account on the 15th. You then could have transferred that money to a bank account of your choice, or used the funds to make further investments.
Please, sir, I want some more.
Dividends are very beneficial because they allow you to profit from a stock even if the share price has gone down. You don't have to worry too much about the share price if the stock is still paying out good dividends and it looks like the company is financially sound. You can sit back, collect the dividends, and make a profit while you wait for the share price to go back up. The profit you get from a stock's share appreciation, plus its dividends, is known as that stock's total return. Historically, the stock market has averaged a return of 10% a year, or 7% a year when adjusted for inflation. The total return for stocks is higher than for any other asset class. The problem is that stocks can be very volatile in the short term. It's very possible for stocks to go down 30 or even 40% in 1 year like it did in 2008.
No!
On the other hand, it could also go up 30% a year like it did in 2013. These swings are almost impossible to consistently predict, which makes investing in stocks a risky proposition in the short term. However, their superior total return make them your best choice for long-term investing. In our next lesson, we'll discuss the remaining 3 major asset classes: bonds, cash, and real estate.